Good morning, one and all. Welcome to Acharya Patashala College of Commerce. In the light of COVID-19 and upcoming UGC, NET and KCET examination, we have organized today's webinar on corporate tax planning for NET, KCET aspirants as well as PG students by the renowned resource person, CMA Sri Professor Venkana S. And this webinar would not have organized without the support of our management, APS Education Trust, and our principal, Dr. Mukund Nayak, who is the great spirit of encouragement and inspiration for all of us to organize this webinar today. And I request our principal to welcome and introduce the resource person of today's webinar.
Welcome to Acharya Patashala College of Commerce. Today's webinar seminar, Corporate Tax Planning, organized by Department of Commerce and Management. It gives me immense pleasure to welcome our Honorable President, Sri T.V. Maruti, and also Honorable Vice President, C.A. Sri A.P. Acharya, and also welcome Honorable Vice President C.A. Sri Vishnu Bharat, and also welcome Honorable our General Secretary Professor K.P. Narasimhamurthy, and also welcome Honorable Joint Secretary Sri Mulidhar, and also welcome Honorable Joint Secretary Sri Krishna Swami, and also Honorable Trustee and Mentor Sri Mohan Dev Alva, and also welcome Honorable Governing Body Chairman Sri A.R. Acharya. I also welcome today's resource person CMA Professor Venkana, former ICWA chairman, who served for more than 2 decades, and even today he is actively associated with CMA Institute. Moreover, I am proud to say that he is our college alumni during the year 1968 to 71. And I welcome all the participants for today's webinar, and also welcome our staff and non-teaching staff of our college for their wholeheartedly support in this program.
Good morning to one and all. I think I am overwhelmed by the response by the people who are joined for this webinar. First of all, I thank my college, APS College of Commerce, for having given me this opportunity to share my thoughts on the topic corporate tax planning. I thank the principal, Dr. Mukunda Nayak, and also Dr. A.P. Sudha, the head of the Commerce Department Postgraduate Center, for giving me and calling me to share this some of the thoughts on the corporate tax planning. Thank you very much for you also for having joined this webinar. Now, so far as the corporate tax planning subject is a very, very vast area. So I will sum up and talk about the overall what is that they have to do and all those things. To start with, whenever we talk about the income tax or whatever it is, tax like that, the tax authorities immediately catch the people, irrespective of the relationship and all those things. In a later vein, in a fast train, a person was moving and he was required to get down. but nobody was helping him to get down to the platform. A person was standing on the platform with a neat dress. Then this fellow asked that fellow, "Who are you?" "I am a tax person." Then this person told him to catch me. So when he was used the word "catch me," immediately the tax officer pulled him onto the platform. So why I am telling you is that the income tax authorities invariably, even without with regard to any other things, they will catch that. So it is very much essential to plan the tax payment by the public citizen. So normally I use the word tax is a fine for doing right thing. Whenever we do right things, we'll have to pay the tax. It is a sort of a fine. I don't say it is a fine because we are contributing to the exchequer, government, etc. Suppose if I do wrong thing, I will pay fine as a tax. So tax is a fine for doing right. Fine is a tax for doing wrong thing. So under these circumstances, it is very much essential to plan for the tax payment by everybody. If a person does not plan and disregard all those things, no problem. That is not a problem. But money is important for everybody. It is very much essential for everybody to plan in advance what is the tax payable, etc. Because it will have impact on the personal purchasing power of the person. If a more and more tax is payable, the purchasing power of the person will come down. So it will affect the economy, standard of living, and all those things. So very important that everybody tax planning has to be done in advance. Normally, tax planning will be done on two types, so short term or long term. Short term, most of the time, it is relating to only 1 year only. Long term may be extend to more than 5 years, 10 years, and all those things in a corporate sector, especially in a corporate sector, because we are talking about the corporate tax planning. I will stress more upon the corporate problems and how they are going to plan and all those things. So as a result of that, tax planning has to be done in advance. Otherwise, they will end up in the payment of higher taxes. So there will be a lot of litigation. These are all going to be the results of the lack of proper tax planning and all those things. So this is what is going to be the corporate tax planning. Tax planning is a general subject, but it is relating to corporate sector. Tax planning can be for anybody. So because here in this area, I will only touch upon more on the corporate sector, how it is to be done, what is the tax planning methods and all those things. First of all, why is it tax planning? Tax planning. So we have to avail the benefits of income tax. Lot of income tax provisions are available in the law. So we have to understand and avail the benefits so that we can reduce the tax liability. That is number one. First of all, because payment of taxes comes, it has a psychological impact on the person for the payment of tax itself. So as a result of that, always we think that we have to reduce the tax, or why I should pay the tax. Why I should pay the tax is a extreme level. But if I am required to pay the tax, can I pay the tax at a lesser rate or reduced rate? So very important objective of the tax planning is to reduce the tax liability. Next one, avoid litigations, etc. So these are all the objectives of the tax planning, why and all those things. Then it comes to methods of taxation. Well, there are various methods of taxations are there. If a generally applicable, there are some principles of taxation. There are 4 principles of tax planning. Number one, everybody, a taxpayer has a residential status. Section 6, so there are so many things, residential status for all the type of the taxpayers or assessees, we call it as. So depending upon the residential status, the tax planning has to be done. A non-resident or a resident or a not ordinary resident in case of an individual, all these things has to be planned. I will give you 1 or 2 cases of the non-resident, how he is going to avoid the tax so that how we can reduce the tax liability. So you have to keep it in four parameters. One is a residential status of a assessee, a tax person. He may be an individual or a HUF or a company, partnership firm, all the types of assessees. Next to number two is the heads of income. We have five heads of income, you are aware that. So depending upon the heads of income, nature of income, planning has to be done. Salary, a simple short term planning has to be done for the tax planning. In house property, short term. Then capital gain will have a long term planning and all those things. Especially under section 28, where there is a business income relating to the corporate sector and business sector, a planning is very much essential because it will have an impact on the profitability of the company. So as a result of that, the heads of income will play an important role in tax planning. Next one is another important thing I am using is forum and substance. This is a legal word I am using, always people use for tax planning. Forum and substance. This is known as only documentation and the subject matter of the tax planning, tax liability, etc. If it is written in one language, it will attract tax liability. Suppose if it is written in another language or in another forum, there may not be any tax liability. Forum and substance. So again, when it comes to the substance, very important, you will have to disclose the full facts of the case. That is the substance. So all these four things play a very important role in tax planning. I will give an example, one or two cases also. There are methods of tax planning. Normally, we have three methods of tax planning. One is, first of all, tax planning. It is an advance action. Next is tax avoidance. How to avoid the tax. The third one is the tax evasion. So, three methods are there for the purpose of tax planning. First one is the tax planning. It is legally done. We have to understand the provisions of the income tax law. There are various provisions, advantages are there. If you are able to catch all those things for the advantage to reduce the tax liability, so we have to use that. So we should have a knowledge of all the provisions. Use the provisions available in the tax law for the purpose of tax liability. Make it in advance planning so that you can reduce the tax liability. That is, the tax planning has to be done. Tax planning is legal, allowed under the law. Next comes to tax avoidance. Sometimes what happens, there are lot of laws are there, income tax law is there, income tax rules are there, then other rules are there. So all those rules have some loopholes in the law. That means there is a wrong interpretation. Language is in such a way that the interpretation varies from person to person. So as a result of that, it is interpreted to the advantage of the person. So try to avoid the tax. This is known as a tax avoidance. You can do that. It is allowed also. But if you do the tax avoidance intentionally to deceive the government, that is, cheat the government for the payment of revenue, it is known as a tax evasion. If it is legally allowed without any intention of cheating the government for the tax payment, tax avoidance is permissible. In this aspect, I want to tell you, in the year 1985, Supreme Court judgment first time used the word called colorable device. It is called as a colorable device in 1985. This is in respect of the McDowell and Company, Chennai, a Tamil Nadu company, UB Group, liquor manufacturing company. The Supreme Court Judge Chinnappa Reddy, O Chinnappa Reddy, has used this word colorable device. The company has used the language in such a way that try to avoid the tax. But legally, the intention of the company was to deceive the government for payment of tax. The calculations is made in such a way, I will not go into how the McDowell company has reduced the taxability by dubious method. I will say dubious method. This is nothing but dodging the tax. Dodging the tax. So, if anybody uses the colorable device, because it affects the tax liability to the government, this will not be allowed in law. But if the intention is good and if it is legally allowed, it becomes a tax planning. Tax avoidance may be legal or illegal also. The third method is the tax evasion. Tax evasion is nothing but completely avoid the tax, not paying the tax. There are various methods are there for tax evasion. This is results in a tax liability lesser amount. This is an illegal activity for the tax planning. It is not a tax planning at all. It is only not paying the tax. There are a lot of evils of tax planning. Bad tax planning, tax avoidance, or tax evasion has a lot of evils on the society, because the society has a lot of legal status. People have to live, government has to live, government is required money. We are all citizens, so we should have an ethics, so that we'll have to contribute to the development of the country. So all these things depends upon this one. So colorable device, if it is used to the advantage of the taxpayer to intentionally reduce the tax liability, it is becomes illegal. If a loopholes are there, if the interpretation is made, and if the law provides for that, there is no problem at all. In this case, colorable device is used by that company. Later on, I will tell you how the people are going to use the sentence, language, and all those things to change or reduce the tax liability. Next to methods after that, what is a tax avoidance? Various things are them. I will give you. So use the loopholes in the law, legally or whatever it is there. Use the defects in the law. Lot of things are there. So no ethics, dodging, etc. These are all tax avoidance. So it becomes illegal. It is also unfair. So tax avoidance. There are a lot of people for the purpose of tax avoidance or tax evasion. See, there are 3 or 4 people who helps this tax avoidance or tax evasion. If a tax planning is done, there are a lot of people there. First of all, number one, advisors. Advisors who knows lot of tax loopholes and all those things are there. They are the advisors. So how they are going to advise the client and all those things? So number one. Secondly, there are legal persons, lawyers. You know, lawyers, how they interpret the language for the purpose of advantage or disadvantage. They also help the tax avoidance. Then another important person is an accountant. We are all accountants. We know how to or crooked, make a false accounting and all those things. So accountant also is a part of the tax avoidance. If he maintains a wrong accounts, so that nobody will be able to understand, only that fellow will understand, it results in a tax avoidance. For that, there will be a support from the company management also. The third one and the fourth one, very important, tax authorities. I don't say the tax authorities also are going to be transparent and all those things. So sometimes in all these cases, all these people will help tax avoidance, which is a very bad for the society. So as a result of that, a good tax planning has to be made by everybody. In this respect, when I am talking about that, how the people interpret and all those things, the language, one case I have already told you, McDowell case. So next one, latest, in the 2009, there was a transaction between the two non-resident companies. Maybe you have heard of this, Hutchinson and Vodafone company transactions. Vodafone company has purchased the network system of India from the Hutchinson Hong Kong based company, and Vodafone has entered into a contract with Hutchinson to purchase the network for the purpose of operating the network in India. But they have used the form and substance in such a way that tax payable in our country, India, is avoided. It is a bad tax planning. You know what they have done, that both of them are non-resident company. So they have interpreted that for any transactions between two non-resident does not attract tax. But the transaction is relating to a business activity in the India. India is a taxable area. So what happens? They entered into a contract in foreign company, foreign country, thinking that there is no tax liability. So later on, it becomes an issue. Government of India has woken up. The amount involved nearly about 17,000 crores in 2009. Notice ban issued, and the various taxes, tax liability, TDS, and all those things. So finally, because there was a loophole in the Income Tax Act itself, Supreme Court said if you want, you can change the law. So what happens, in order to overcome the loss of revenue to the government amounting to 17,000 crores, the government of India has amended the Income Tax Act 1961 from the retrospective effect of 1/4/1962, first amendment in the history of the country so far as the income tax is concerned. So this is one way of tax avoidance. Amount in this case, the amount involved is about 17,000 crores. There are a lot of people also involved. The person who has argued in the Supreme Court is not there now, and all those things. Let us not bother about all those things. So these are all the areas where the tax planning has to be done. Now, I am not going to touch upon the salary, capital gain, and all those things. So straight away, I'll go to corporate sector where the tax planning has to be done and all those things. In case of a corporate sector, there are a lot of things that you have to look into that for the purpose of tax planning. So there are various available provisions are there in the income tax so that the tax liability can be reduced. What are the areas in which the tax reduction can be done with the help of the management so far as in a corporate sector? Number one, management decisions. Decisions has to be taken with regard to various aspects. Investment, when it comes to investment, or when it comes to acquisition of a capital assets, and when it comes to starting a new business or whatever it is there, management has to take a decision with regard to the investments. So for example, one example I will give you. For example, acquisition of a capital assets. If a company wants to acquire a capital asset, there are various ways in which the capital assets can be acquired. One, by investing the own funds. The second one, instead of investing the own funds, they can borrow loan from the bank and invest in capital assets. The third one, I don't want to acquire the capital assets, but I will hire it in the form of lease. So management has to have a long-term planning, tax planning for this type of capital assets, especially when it involves a huge cash flow. For example, a company wants to invest about 10 crores in a capital assets. For example, normal course, I will tell you what is the advantage available in a tax law so far as the business is concerned. Under Section 32, depreciation is allowed because the company becomes a owner of the assets. So the first important advantage is that there is a depreciation allowed on the capital assets because it is the company is the owner of the capital assets. Number one. In addition to that, in the manufacturing sector, there is another depreciation called additional depreciation. Normal depreciation on the plant and machinery is 15%. Additional depreciation is about another 20% about that. So the advantage of taking the depreciation, which will be allowed as a deduction in computing the income, is a very well. For example, 10 crores are going to be, just a small example, 10 crores are investment. What is the saving? Saving will be 35%. 3.5 crores will be the saving as a deduction in the form of depreciation in the first year itself. On 3.5 crores, if I take a 30% tax, it comes to more than 1 crore, 1.05 crores. The tax straight away reduction will be there. So there will be a tax inflow. Tax saving results in a tax inflow. But all these things has to be planned in a long term. Normally, we use the present value method and all those things for the purpose of determining the decision and all those things, depending upon the life of asset and all those things. Second one, instead of investing the money on the company only, take a loan and acquire the asset. If a loan is taken for acquiring the asset too, there are advantages in the Income Tax Act. Number one, the loan interest is allowed at a deduction. Again, there will be depreciation also. Also, in addition to the normal depreciation, there is a deduction for the interest also. So, tax liability also can be reduced further also. This is the advantage so far as taking loan and invest in a capital asset. Coming out to the alternative decision, instead of acquiring the asset by investing money and all those things, hire an equipment for a long period, pay the rental, it is known as a lease rentals. As usual, under the income tax, the lease rentals becomes a revenue expenditure. It will be allowed as a deduction in computing the income. As a result of that, there will be a reduction in the tax liability. So these are all things that we have to keep it in mind. There's only one example I give you. So next there are other ways: location, mergers and acquisitions, location of the companies, then make or buy decisions. These are all other areas where the tax planning can be done. For example, location, I will talk about that. For example, if a company unit is located in a normal way, DTA, domestic tariff area, that means India, as usual, the capital assets is eligible for depreciation, additional depreciation, etc. Section 32 AC, there is another provision where if a plant is located in a backward state like Telangana, Bihar, West Bengal, and Andhra Pradesh, there is an investment allowance to the extent of 15% is allowed on the capital assets. This is a perfect planning for the reduction of the and all the profit. Probably when a company starts for more than 2 to 3 years, the company need not pay any tax liability because there will be lot of tax reduction also by way of getting a reduction. So in a backward states, if a plant is set up and invest in a capital assets, 15% normal depreciation, 20% additional depreciation, investment allowance 15%, totally 50% straight away in the form of depreciation will be allowed as a deduction from the profits of the company. This is a perfect tax planning so far the capital investments is concerned. Another management decision: whenever a company needs money for the purpose of operations, etc., or investment, there are various ways of financing. One is a debt, another one is equity. So we'll have to find out the advantage of taking a equity, issue additional equity to the shareholders, or take a loan from the banks in the form of debt. Advantages, disadvantages are there. When you take a debt from the bank, there is a reduction for the purpose of interest. And again, in case of equity, there's no repayment. Only when a company makes a profit, dividend has to be paid only after paying the tax and all those things. So these things we will have to plan and all those things. Then the form of organization. Normally, since I am talking about the corporate sector is only a company only. But in other cases, there are various forms under which advantages, disadvantages will be there in regarding the form of organization. It may be a partnership firm, proprietary firm, company, etc., private company, public company. Especially in case of a public company where the public is substantially interested, tax planning is very much essential. Otherwise, because here public is involved. So these are all the area where the tax planning has to be done perfectly. Next, coming on to the organization. Organization, what type of organizations we should have, where I have to set up, whether I have to set up in a normal area, whether I can set up the organization in a special economic zone. There is a provision for reduction of the profit for the made by the company in a SEZ under section 10A is there. So these are all things that we have to keep it in mind for the purpose of tax planning. Next, very important is that whenever we have to implement a transaction, there is a legal provision in Income Tax Act to take a opinion before implementing the actions. In the income tax, we call it as an advance ruling. In an advance ruling, if I want to have the tax implications, we'll file an application to the income tax department and give the opinion of the tax implications. In that case, what will happen? Depending upon the transactions, the authorities will give an opinion on the transactions. What is the tax liability, whether there is an exemption or not. Normally it happens, we will have to have an opinion. If the opinion in the form of advance ruling, it is advantageous, transactions going to be implemented. If the opinion is not favorable and all those things, the company may not implement the transaction at all. This is advance ruling. In taxation, it is also called as a prior tax ruling. This also we have to keep it in word so far as the advance ruling is concerned. These are all the basic things that we have to keep it in mind so far as how a tax planning has to be made and all those things. Next, I will come to some of the actual instances how we have to reduce the tax liability in a corporate sector. You all know that when you are doing a business, for all the expenditures, lot of deductions are there. There are lot of deductions. Section 30 237, so many deductions are allowed in respect of the business done by the companies or anybody for that matter. So it is, we have to think about that, understand all those provisions to get the best deductions so that you can reduce the taxable income and finally results in a tax liability reduction. So we have to compute the income and compute the tax liability by taking the advantages available in the income tax act in the form of exemptions, deductions, and then rebates, allowances. All those things are there so that we can use for the purpose of reducing the taxable income, finally resulting in a tax liability reduction, etc. So these are all things. Now we'll come to, for example, some one or two cases. Depreciation, I've already discussed about that. Coming on to some of the other provisions, expenses incurred for business, statutory payments made by all those things, we'll have to comply with all those things. If we are able to understand all those things, then it is better. Also, it results in a very good advantage of reducing the tax liability. For example, one of the section 40, I will talk about that. There are a lot of disallowances in income tax. So if you are going to comply with that, there will be tax planning. For example, if you know, we have a provision of TDS and TCS. When we want to deduct the TDS according to section 193 to 195, we have a lot of rules. We have to understand all those things, deduct the tax properly at the rates indicated in the respective provisions and pay that to the government. Suppose if you do not comply with all those things, it results in a non-deduction of all those expenditure in computing the business income. So these are all things about the tax planning. We have to keep it in mind. Next, I will come to about statutory payments due to the government. There is an important section in the Income Tax Act, section 43B, where some of the statutory payments, if we are going to make to the government within the due date and all those things, there is a provision to get the deductions and all those things. If we do not properly plan and all those things, all those deductions will be treated as a deemed income. We have a section 68, 69 and all those things. Some of the payments, if we are not going to make it to the government, it will be treated as a deemed income and results in a tax payment to the extent of 25%, 30% in the corporate sector. This is about that. When it comes to company, there are other losses the company is going to incur. How it is to be carried forward so that in the next year, the company is able to absorb that previous year losses. One compliance I want to tell you, the company, even though loss is made by the company, will have to comply for the purpose of reduction of the tax liability in a future period. This year, the company has made the loss. That loss has to be carried forward to the next year. Next year, if there is a profit, there will be tax liability. That also can be reduced, provided this loss of the previous year is going to be absorbed in the next year. But there is a compliance. What is compliance? The company has to file the income tax as per rules. Section 139(1), you know that reduction, compulsory filing of the income tax returns before the due date. If the company, one thing I want to tell you, if the company fails to file the income tax returns under section 139(1) before the due date, the company is not allowed to carry forward the losses. This is an advantage. So what will happen? You have to take the compliance. If I do compliance properly, company and all those things, there is a provision to carry forward these losses for a period of 8 years. These are all the advantages. Again, when it comes to depreciation, when there is a depreciation, when there is a loss, there is a provision under section 32 to carry forward the depreciation in the form of unabsorbed depreciation, which can be absorbed from the future profits any number of years. These are all tax planning area so far as the business is concerned in a corporate sector. Next to other things that set off, how to set off the losses. Company may have so many businesses, so one company profits, so another unit making a loss and all those things. We have to understand most of the section 70, 71, 72, all those things. These are all details available and all those things. Then there are other deductions under chapter 6A. This point I want to tell you. Under section 80, there are a lot of infrastructure companies where they need not pay tax at all for so many years, 5 years, 10 years, that there is no need for tax payment at all. But only thing, they are required to plan properly to take all those advantages so that they need not pay the tax at all. There will be a reduction in the tax liability. Not only reduction, they need not pay tax for some period also, 5 years, 10 years. Lot of section 80C, 80C and all those things are there, 80CCB, 80IA for the purpose of infrastructure companies. So all those things we have to properly plan so that the reduction can be done in a proper planning. So these are all the areas for the purpose of computing the income so that the tax liability can be reduced at all. Next is comes to tax payments. There are due dates for tax payments. So, for example, if you want to pay the tax, TDS is made, there is a due date under the Income Tax Act. Every month on or before 7th day, 7th of the subsequent month, all the TDS payments has to be made to the government. Otherwise, there is a penalty, increases the penalty, increases the fine, double the TDS amount. In addition to that, interest also is payable. In addition to that, in a serious cases, there will be a prosecution also. So, in order to avoid all those things, we will have to understand the whole system of taxation rules, provisions, etc., so that we can reduce the tax liability to the extent possible and all those things. Now, coming on to other area, okay, other area where the tax can be reduced. I have already told you so many cases so far as the reduction of the tax liability etc. is concerned. Then coming on to make or buy decisions etc. Whenever the products has to be manufactured by the company or it can be purchased in the market for a market price. If it is manufactured, what is the cost involved? The cost expenditure is going to be deducted as an expenditure in the manufacturing. If it is purchased, what will be the cost? This is another area. This is known as a make or buy decision. Make or buy decision. You will have to understand that there is a lot of working has to be done on that. A detailed working has to be done. Most of the time, it is a long-term tax planning has to be done in a corporate sector. This is about that. When it comes to investment, tax planning in an investment, capital assets, acquiring a capital assets, it is for everybody, not only corporate sector or whatever it is there. So we have to think about the capital investment in various forms, where is to be. We have got lot of advantages, provisions in the income tax section 54 onwards. What are all the deductions available for a profit made on a capital asset when it is sold and all those things, equally applicable to the company also, because company is required to pay tax on a short-term capital gain at the normal rate only. If it is a long-term capital gain, you know that concessional rates and all those things. So there are a lot of planning has to be done so that the company corporate sector can really reduce the tax liability. Then another important area so far the tax planning is concerned in respect of the corporate sector, I will come to the minimum alternative tax. It is one of the important steps so that the corporate tax planning has to be done with respect to minimum alternative tax. Section 115 JB. In respect of the section 115 JB, every company is required to pay the minimum alternative tax at a reduced rate, not at a normal rate on the book profit, not on the income tax computed under Income Tax Act. Every company has to do this exercise in a prudent way without any dubious methods so far the records are concerned. For this purposes, every company is required to compute the book profit as per section 115 JB. There are some additions to the net profit, deductions to the net profit. In all these things, how to compute the book profit, one point you have to keep it in mind for the purpose of the tax planning is that always when a profit and loss account and balance sheet is prepared, you will have to keep in mind the Companies Act provision. Companies Act 2013 provision is there where the balance sheet and profit and loss account is to be prepared in accordance with this Schedule 3 of the Companies Act. If a profit and loss account is prepared in accordance with Schedule 3, the Income Tax Department will adopt the net profit so that the book profit computed will be perfectly done. Otherwise, what will happen? The book profit computed will have a dispute by the tax authorities on which the tax is payable at the lesser rate. In a book profit, tax payable is at 18.5% against the normal rate of 30%. So, whenever there is a lesser profit, under the Income Tax Act 1961, applying all the provisions, normal provisions, section 30 to 37, 40 to 44, section 70 to 71, 70 to 73, section 80, then section 139, all those provisions, even if you apply, then there will be a income lesser on that. Whenever the company makes a book profit on which tax is payable at a lesser rate, but the amount of is very high. So what will happen? Under section 115 JB, there is a provision to carry forward the excess tax paid. So what will happen? We have to keep an account. When an excess tax paid, next year we have to see that to improve the corporate performance so that you can reduce the tax liability. If already tax has been paid under minimum alternate tax in the earlier year, next year what will happen? You will have to avail the tax credit advantage under section 115 JAA. These are all sections I am going to use that. These are all where the minimum alternative tax, where the tax is paid is over and above the normal tax, will be allowed as a deduction from the normal tax if it is higher than the minimum alternative tax. So this point I want to tell you so far as the minimum alternative tax is concerned. Then coming on to other area where tax planning has to be done. Some of the companies, they have to invest capital assets in for the purpose of scientific research. A company has to carry out the scientific research. For that purposes, the company is required to invest huge amount of money in the capital assets. So there is an advantage in the income tax section 35 to claim lot of deductions from the profit so that the tax liability can be reduced. So investment made both in capital as well as revenue expenditure incurred for R&D expenditure, which is relating to scientific research, there is a lot of deductions available under section 35. There is a weighted deduction available, not only 100% of the expenditure for the contributions made to the outside organizations. There is a weighted deduction of 175%, 200% for the in-house research, etc. These are all the things available so that deduction can be done. So under scientific research, there is a provision, there is an expenditure incurred for business. All those things will be allowed as a deduction. But simultaneously, whenever an expenditure incurred for various companies, there is a specified business that the company has to carry out the business so relating to various business activities. Some of the examples of the specified business, agriculture sector, or infrastructure sector, or then fertilizers, so manufacturers of housing for the underdeveloped. All these sectors are specified area. If a company is able to set up the organization in that area, lot of deductions. If a capital investment is made and revenue expenditure is incurred, 150% of the revenue expenditure is deducted as a deduction from the profit of all those organizations. It is a perfect tax planning so that the companies can save a lot of money so that in the form of tax liability reduction and all those things. So these are all the things where tax planning has to be made. If I go on detail and all those things, lot of things are there. You have to understand some of the techniques of the present value method, IRR method, because we have to also, and also debt equity method for the purpose of raising the capital for the funds of the company and all those things. These are all the area where you will have to have a plan for reduction, substantial reduction in the tax liability. These are all the things. Then it comes to next very important compliances portion I want to talk about. Lastly, with all those things, we plan, make a tax planning, everything we make, use the provisions and all those things. Whenever there is a compliance part is concerned, I use the word tax management. Already in the beginning, I told you there are three methods of tax planning. One is a tax planning, tax avoidance, tax evasion, which is illegal. In addition to these three methods, there is another method called tax management. Tax management is nothing but a in-house housekeeping. If you keep the house properly, there will be reduction in the tax liability. If we do not maintain the house properly, house management and all those things with regard to various compliances, probably the company will end up in paying the huge penalties, fines, sometimes even go to the extent of prosecution also. If you are going to, as in a company, if the people are going to behave in a problem and all those things, they will be going to the extent of prosecution also. One example I will tell you. In a company, a director has been arrested for deviating the income tax rules and all those things. Then the director said that, okay, you can arrest me because you do not have a money to pay salary for the employees. So employees are making lot of disturbances for salary. So you please take me to the jail and keep it to me. So these are all the attitude of the corporate sector. It is not going to be advisable, I will tell you. It is not a tax planning. It is called as a tax dodging. It is my example in one of my company how the director has behaved with the tax authorities. He has requested the tax authority to arrest him and put him behind the jail. You know, he is a class 1 prisoner. He will become a class 1 prisoner. He will be put it in a comfortable place. So there is no problem because he will be overcoming the headaches of the various people who are going to demand tax and money and all those things. So these are all not tax planning. These are all tax dodging only. So when it comes to tax compliance, I want to tell you, you will have to maintain proper records in the company. Very important record. I told you in the paramount substance, one of the method of tax planning is to keep the records properly because you have to have a transparency. So if you maintain the proper records and all those things, it is better. Because otherwise, what will happen? An accountant or whatever it is, if he suppresses the income by making a false document, it results in a bad tax planning. It results in a tax evasion. Tax evasion is illegal. So housekeeping, maintenance of the records properly, accounting, everything has to be done properly so that compliances can be done. Now, for example, filing the returns, there is a due date already I told you. You will have to file the returns. For example, you take a TDS returns. TDS, when a company deduct the tax from the various payments made under section 192 through 195J, even in respect of the foreign and all those things, they have to file the quarterly returns. Even if they one day, if they don't file the quarterly return before the due date, every day they have to pay a fine of 200 rupees per day. Not only that, whatever the tax amount deducted and not paid to the government, the penalty will be under section 271, double the penalty. So these are all things going to result in a tax liability, more and more fines, damages, prosecution. So in order to avoid all those things, it is have to have a compliances. So once the income tax returns are filed, it is not going to end up it. There is a next question comes under the assessment. Whenever there is an assessment, there are various types of assessments are there under section 144 and all those things. So 143, 144 and all those things. If everything is done properly, there will be a summary assessment. Notice will be issued accepting the returns. If it is not there, most of the time, the income tax department will issue notice for production of the proper document to prove that the income is computed properly and the tax liability has been paid correctly. So what will happen? You will have to answer the tax authorities. If we are going to try to avoid replying to the tax authorities notices and all those, it is a bad tax planning. No doubt. You may have made some mistakes, interpretation and all those. But it is for you, the person who is going to present himself before the tax authorities, the nature, transaction, etc. It may be acceptable by the tax authorities and it can be pardoned. So to keep a proper records, etc., so that the tax liability can be reduced. Another one I told you, a perfect tax planning to avoid the interest payment, demurrages, etc., and all those things. So paying the taxes to the government on due dates properly. For example, all companies are required to pay the tax in advance under section 288. So what will happen? All the companies, not only companies, all people who have earned the money is required to pay the tax in advance. There are three methods of payment of tax to the government. One is an advance tax. Second one is the TDS payments deducted and paid to the government. Third one is the self-assessment tax. So tax planning has to be done for all these three methods. Number one, advance tax. There is a schedule of payment of the advance taxes by the companies to the government. So there is a due date to how it has to be done, how it is to be calculated. So planning has to be done to estimate the whole year income in advance in the month of June itself. Then calculate, determine the income. It is all self-assessment. Company itself should make an assessment, taking all the provisions of the income tax, claiming the deductions, rebates, etc., and all those things. So find out the income, find out the tax liability, pay the taxes in installment according to the provisions to the government. If the advance tax is not paid by the company, it results in a tax evasion, tax avoidance. It results in a penalty also. Next, not only that, under section 234A, 234B, 234C, and all those things are there, where if the advance tax is defaulted, there is a liability to the paid interest at the rate of 1% per month. So these are all the areas where the compliances are required to be made by the corporate sector. Next, very important, tell you, Companies Act. Not only Income Tax Act. When we talk about the tax reduction, there is a provision for to comply with the Income Tax Companies Act also, with regard to the assets and all those things, methods of depreciation, etc., will have to keep and understand properly and all those things. You know that in income tax, the WDV method of depreciation is allowed under a Companies Act to straight line method. So we have to keep that. Next, very important with regard to the residential status, especially in a corporate sector, resident and non-resident. You know, all the Indian companies registered under the Companies Act are subject to be a resident only. Irrespective of the income made in anywhere in the whole world, the companies are required to pay the tax. Non-residents, if the business is done in India, Section 9 applies, tax has to be paid. In the beginning, I told you Vodafone case. The business is done in India, but the transactions have been done in a foreign country. So it is nothing but a tax avoidance, I will tell you. I'll tell you. So what is the intricacies of the transaction? For a business to be done in India, transaction done in a non-resident in foreign country to avoid the tax amounting to nearly 17,000 crores in the beginning, I told you all of those things. So there are various things are there so far the tax planning is concerned. But one thing I want to tell you, in order to have a very good tax planning, a person who is going to deal with this tax matter is required to acquire the very good knowledge, provisions of the income tax law, how to use the provisions of the income tax law to the advantage of the taxpayer in order to reduce the tax liability, in order to reduce the legal provisions, penalties, etc. And I already told you prosecution. All those things can be avoided. It is a tax planning. Tax planning just is not only reducing the tax liability, it also keeps the mind be freely. If a person is required to pay the tax and if he trying to dodge, evade and all those things, his mind is not free, I'll tell you. So I told you a Chinnappa justice in a McDowell case, he has used a lot of things so far as the society is concerned. We are all true citizens. We have to have the ethics. The society will collapse if the person does not plan properly and be taxed correctly. If you pay the taxes properly, the person will be happiest, etc., and all those things. So these are all the things we'll have to keep it in mind. So many things are there. It is a vast area. We can discuss very long time so far as the tax planning is concerned. So these are all the things. I hope in a nutshell, within a short period, the whole thing, which are contains a huge provisions of the Income Tax Act, I have presented myself. I hope you have got some little knowledge and advantage of my deliberation on the corporate tax planning guidance. What are all in store for you to understand also I have given. I only given some sample food to you, but there are a lot of things that you have to take it and digest it so that a person will become a tax expert. Because normally tax expert he has to have a very good high skill and knowledge so that he can plan and advise the management, not only for companies, various things also. A very good area, a professional, high level area, so far as the tax planning area is concerned. All the professionals, we have a very good role to play in the society to make the society proper, etc., so that the economy, economic development, GDP, everything will grow. When a country, people grows, country will grow. So this is the ultimate object of the perfect tax planning, so that every citizen will have to do and comply with the duties. Thank you very much for the opportunity given. I hope I made it clear. I think I will end up my discussion on the subject. Thank you very much, one and all.
Thank you very much, sir. So the session was very informative. I, Shankar, Assistant Professor, APS Commerce College. I now thank our today's resource person, CMA Professor Venkana sir, for his valuable guidance and sharing his knowledge related to the topic and informative. Thank you, sir. And I also thank our management, Acharya Patishala Educational Trust, for supporting this uh, webinar to get organized today. And I thank our principal, Dr. D.M. Mukundanayak, our vice principal, DC Shivana sir, and our webinar coordinator, Dr. B.S. Sudha madam, and members Rajamuthu, Sushmita, Uma, and Srilakshmi V. Kittur. And I also thank our HOD of Commerce, BP B. Parmesh sir. And now I thank all the participants of this webinar who has participated and has gathered and acquired the knowledge due to, by this seminar. And I also thank our non-teaching staff who has helped us to conduct this webinar successfully. And there is a note to the participants that all the participants are requested to give a feedback on this webinar, where that feedback form will be sent through the mail shortly. Thank you.